Welcome back. There's been a bit of a fall from the day's high for the Nifty. Now it's around about 70 points off the highs of the day, and 25,130 is now where the index is. Has come off even more from when we began the show. We began at around 25,150 levels. So some bit of profit booking coming in at higher levels on the weekly expiry session. But Gautam Baid of Complete Circle Stellar Wealth PMS is joining in. Gautam, thank you for staying by. Now, the IT has been the big talking point, right, over the last couple of weeks now, whether it be the visa issues or whether it be the other services related actions that the Trump administration has been taking. We are seeing some bit of recovery coming in from beaten down levels ahead of TCS's results. Is there something within the small cap, within the large cap or the mid cap IT space that excites you ahead of the earnings season and could end up delivering a positive surprise?
Sure. So hi Hormuz, hi Sonal. Thank you for having me on your show. Well, the sentiment has been very bearish for IT over the last few years, and there is a very valid reason for that. We all know that large cap or legacy IT services companies are going to be very adversely impacted by the continued adoption of AI. But in the mid cap space in India, there are certain product companies. We do not have them in our PMS currently, but they are companies that we're evaluating. So rate gain on the back of the recent mega acquisition, as well as Intellect Design Arena, which has launched this AI platform called Purple Magic. I think they are doing some interesting work in the IT product space. That is probably an area which investors can look at to study, because in these kind of product companies, the revenue growth is pretty non-linear, and the bottom line, once the initial customer acquisition is done, then after that the bottom line grows pretty disproportionately. So I think these are some areas within the IT space that you can look at. But within the large cap space, given their constant currency growth rate of low single digits and their high valuations, so the price to earning to growth ratio, the PEG ratio for these large cap IT companies is very high. So basically, you're not getting any value for your money when you're buying these large cap tech companies. So it's good for preserving capital. But India is primarily a growth market for FI. So I think you want to look at growth stocks when you invest in a market like India.
So Gautam, you think Paytm is a growth stock from here on, because that is one of the stocks that you like?
Sure, Sonal. So basically, in case of these new age businesses, the loss to profit framework often acts as a precursor to a J curve in profitability. We have witnessed this very similar phenomena play out in the case of Zomato and Policy Bazaar in the past. Once those businesses became profitable, from there on, they experienced a J curve in their profitability. A similar case can be expected from Paytm as well. In quarter one of FY26, the company reported its first ever net profit since its listing in 2021. And this particular profitability was driven by healthy momentum in its merchants business and steady growth in disbursement volumes. The company sees a potential of more than 10 crore merchants eventually accepting digital payments in India. And over time, the management expects that almost half of these 10 crore merchants will require Paytm's subscription services for managing their business needs. In addition, recently, the RBI gave an in-principle authorization to Paytm to act as an online payments aggregator. So basically, Paytm's payment subsidiary, Paytm Payment Services, can now basically engage in that particular space. So that also removes a long-held overhang on the stock. The key risks to the investment thesis for Paytm is a loss of market share in UPI to competitors like Google Pay and PhonePe. And if the government of India never allows MDR on UPI transactions, then that particular optionality, which is currently embedded in the valuations of Paytm, that will go away, and the stock may experience a derating in that case. But I think the government cannot keep giving subsidies every single year on such a large scale to give basically facilitate free UPI transactions. Eventually, there may be an MDR introduced in the future.
4x now from its all-time lows for Paytm, but still below its IPO price, of course. Gautam, the other name that you like is Windlas Biotech. Now, the stock has done fairly well from its IPO price, although it's come off the highs. What makes you so optimistic on this? Is the management commentary positive enough for you to take a bet on this?
So, Hormuz, Windlas Biotech represents a solid defensive domestic play amid the global tariff and trade wars. This company primarily operates in contract manufacturing for domestic formulation companies in India, and it also operates in the fast-growing trade generic segment. The management has guided for improvement in EBITDA margins to 15% from the current levels of 12.5% over the next 2 to 3 years, primarily driven by operational efficiencies and a ramp up of its newly commissioned injectables business and the fast growing trade generic segment. Both these businesses are high margin in nature. So over time, as the revenue growth will be accompanied by a faster growth in the bottom line of the company. In addition, the implementation of Schedule M by the Indian Pharma Regulator, which relates to good manufacturing practices, will basically benefit large established contract manufacturers like Windlas Biotech, Innova CapTab, Akums, and other large players in this space. So that will also be a tailwind. And this particular company has got a very solid track record of profitability and growth. In the last 5 years, the top line CAGR for Windlas Biotech has been 18%, and the bottom line CAGR has been 30% over the last 5 years. So, given that it trades on a 1 year forward P multiple of just 20 times, we find the valuations pretty attractive. The key risk to the investment thesis for Windlas Biotech is intensifying competition because this particular industry of contract manufacturing in domestic pharma is pretty fragmented. And just a standard disclosure, we hold both Windlas Bio and Paytm for our clients in Complete Circles Telewealth PMS.
Gautam, always a pleasure speaking with you. Thank you so much for joining in today with your thoughts on the markets and individual names. By the way, Hormus pointed out how Nifty is off the highs, even for the mid caps. If you look at the advanced decline ratio, we had highlighted that yesterday it was in the favor of declines. We started with a positive trend, but now we are seeing that there are more declining stocks versus advancing stocks. So while the mid cap index is in the green, we have more declining stocks versus the advances. So we'll keep tracking that for you. For now, we'll slip into a short break. A big story of the day comes up next.